Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, it's Phil Tarrant here. How you going? This is the Smart Property Investment Podcast. Hope you're tuning in sometime over the break, which feels like half of Australia's already finished work for the year. I'm still at it, so another couple of weeks to go as we run up to the summer break, and everyone's talking about property. There's a lot of property stories happen over the break, and call the break. It's that period from late December all the way probably through to Australia Day. Property stories gain a lot of dominance because typically there's not much else going on. There seems to be quite a lot happening internationally at the moment. I was just looking at the news before coming on. A lot of things happening in the Middle East right now, which is driving a lot of commentary. Maybe that will dry up over the Chrissy break and everyone will get back to talking about property prices, what's going to go on with property, what's 2025 going to look like, what's going to happen to interest rates, what's going to happen to the federal election. So we're moving into a year that's going to give guys like me, just a struggling journalist, plenty to talk about. Fortunately, I sort of dialed in with a whole bunch of people who I can sort of pick their brains, see what they're doing, what they're up to, where they're going, what their views are, and hopefully help you make a more formed opinion of where and when and how to shape your investment journey moving forward. One of them is Lachlan Vidler. He's from Atlas Property, regular guest on the show. He's back in for these traditional end of the year, what's going to happen next year podcast. We've been doing this for a couple of years now. Lachlan, how you going? Welcome.
Good, Phil.
Yeah.
Good afternoon.
Good afternoon. You sick of doing podcasts yet, mate?
Oh, no, we're just
do a lot of podcasts.
Doing a lot of podcasts. I think being really candid, which I feel like a lot of people love to put the shiny image out there. Mate, I feel so tired. It's been such a massive year, and you know, you then add in things like podcasts and media and this and that on top of just normal work, and I feel very ready for a break.
Yeah, guess what? They reckon the role of the modern CEO these days, as well as being responsible for all the machinations of a business, you've got to be a big content creator as well now, and you certainly tip your sort of hat to that.
Yeah, oh man, I think part of the issue as well though is that you look at things like Instagram and TikTok, and I guess Facebook has sort of died off a little bit in that respect. That we all just have this very perfect curated image out there, and you see these people who are doing really well and this and like it's, you know, Instagram shit this and it's photos that and all that, but I think it kind of puts a bit of that image out, like you're saying, that there's just got to be all this content, you got to be doing all this and everything, and it's a lot of people take it very far as well.
Yeah,
you know?
Yeah, it's very curated, and what you see on social media is. I've never seen anyone's social media persona actually reflect their real persona. It's very, very different proposition. The challenge you have with that, though, is that people actually use that as a mechanism for how they shape their attitudes to stuff. And I've been pretty vocal over 2024 around, what you see and what's sold to you on social media when it comes to property investment, often very different to what the realities are.
And I think that's the hard part because, and I know I've been guilty of it myself, and I like to think I'm a pretty smart, educated bloke. If you see that same thing, maybe in a different variation, a different car, a different holiday, a different private jet, whatever it is, and it comes up, you know, month after month after month with this person, a part of you starts to sit back and go,
where's my private jet?
Yeah, is it real? Like maybe they really are doing that, you know? But I reckon 9, if not more than 9 times out of 10, it's obviously just so curated, so fake, so just, you know.
Yeah. Hence the reason why they're banned. You know, the legislation Australia's put through around sort of delaying access to social media until 16 or something or other. There's good reason for that. It's bad. Like, you know, when people this year have sort of kids growing up now going, oh, that's my expectation of what my job's going to be is creating content. You know, you see this stuff going. You know, this is the life of a 25-year-old content maker. I get up and I have my berries and then I journal and then I do this, that. And you sit there and just go, that's not your life. Like, why are you peddling that to people who you're negatively influencing? They go, well, how come I don't wake up every morning, have 8 different sort of types of berries with my smoothie, and then I do Pilates, and then I do it's a problem, right? whatever you want to call that happens in property as well.
I think it's one of those things that's like, for whatever reason, humans, we're so nosy and we just want to know what other people are doing. And that's why some of the biggest, social media influencers and people of that sort of variety, that like most of the time they're not somebody who was like even movie stars. Like the movie stars of today are very different to movie stars, going back 20 years ago where they were like the hyper celebrities. Now it's literally like you're saying, the TikTok people who are, this is what I had for breakfast this morning. And it's because, I feel like it's because we love to look at each other like animals in a zoo, and we just want to know how the other half is living or what we believe the other half is.
Yeah.
And then you see, all that little stuff. And then, you give it 6 months and it starts to add up. When you see that creator every day for 6 months doing a certain thing, like 6 months is a long time. It's 180 days, that is not a small period of time. Yeah, it's. And then you get in property as well, not even.
And then, but at least with property, you sort of work out how maybe people make their money. But these other people, I don't know how many creators, influencers, whatever you want to call them, I don't know how they make their money, really. Like, they're just doing paid product vlogs of like, getting free berries and stuff. Like, I actually want to know how they're getting money in their pocket. This is what I don't understand. And this is the issue you have, is that you might have a big following, but often large followings don't actually translate into, significant amount of money. So for some people, they do like Mr. Beast, right?
Oh,
like,
which insane.
is, and you just watch his stuff and you just go, sure, I get it, right? But anyway, the point is, if you choose to get all of your information around property from social media, you're only getting one particular lens and view of it. And, sort of banning it, I think, is smart, because the idea is that over 16 years old, an adult should be able to just be discerning enough to work out fact from fiction. Younger kids, less so. I still see a lot of property investors that aren't able to be discerning about fact and fiction when it comes to investment strategies or how markets work or whatever, because there's still a lot of misinformation out there.
Oh, man. But you know what's really funny though? Like, you say that it's about the fact that they should be a little bit more discerning, and that's obviously absolutely true. Like, they should be more discerning, but it's really interesting, because something I've definitely come to see a lot more of 100% this year, but I've done it for a few years now, is we do lots of paid advertising on platforms like Facebook and Instagram, same as any business, right? Like, whether we're selling, hoodies, or we're selling, something else, or in this case, we're trying to help people create and build a property portfolio. You would be shocked the amount of just poor tasting comments and just the crap that you see that gets commented, and you sit there and you look, and like, it's, I think people forget, like, there's still a real person behind that, and there's still somebody who's going to read that. And even though, these days it's like water off a duck's back, or a lot more than it used to, you go and click on some of these profiles that leave a comment on an ad that we might have running or something, and it's like just the person that's there, and you sit there sometimes thinking, like, what did this person really think they were going to gain by writing some of just the vile trash that they did? And I feel like it just goes back to the idea that we just love to have an opinion on things. We love to see how people live and work and do all that.
I say to all those people, what do you want to call them, trolls?
Yeah.
Why don't you come down and sit in front of me and actually say exactly the same thing? I'd welcome the opportunity for you to do that, and they won't do it. Right?
Of course.
So this is it. In many ways, you're dancing with the devil on social media. It's in many ways, it's not a real world. There is positives of it, no doubt, but there's certainly a lot of negatives. So, the point being, make sure that it might be one area where you choose to obtain your views around real estate investing or strategies, but you also need to get a more holistic view of it. And if you're getting all your information from one channel, you're probably not going to make the right decisions. And that's the way it is. 2024, Lachlan, and 2025. I want to use today as a bit of a chat. We'll probably go for about 50 minutes or so. I've got you in the studio, and to talk about the year that has just passed, and the year as we look ahead to it. And why do you do that? Well, I think it's important to reflect on the previous 12 months, because that may shape attitudes, your interpretation, and therefore your decision making moving into 2025. 2024, it was a pretty standard market. There's nothing really out there which was me groundbreaking or was a seismic shift from markets that have passed, other than we've carried higher interest rates throughout the whole year. So the first year of really high interest rates, 2023. When did interest rates start coming in? It was 2022, May of 2022. So 2 full years of higher rates. How would you explain 2024? If a Martian was to arrive on Earth and you had to tell them, isn't that the story?
Put the podcast in a time capsule.
Yeah.
And, I mean, the internet's the time capsule of today, isn't it? It's not the dirt that we bury it in. How would I describe it? I would probably say that I saw 2024 as a story of thirds. I think that's the way I'd probably say I looked at it. And I think it's really, I think you're right. Like, to me, there wasn't anything significant that occurred. Like, you go back 2020, COVID, markets started to have a lot of really strong performance. 2021, hyper growth, goes insane. Like, you throw a dart at the board, anything happens. 2022, I think it was rates did go up in 2022.
Yeah, May 2022, because the election was in May or June, April 2022.
Because we're 3 years and 25 elections. That makes sense. Yeah. So we start. So then 22, characterized by still some strong performance, but then we had rates start to move and things to happen, and then we moved into 23, and rates kept pushing and pushing and pushing, and then. That was kind of the story of the year. But then we also started to see towards the end of 23 that we were expecting rates to be cut, possibly even at the end of 23, and then that got pushed to, the start of 24. And I guess that brings us to this year. And I think the reason I like to go over this year a little bit is I think it then helps us to understand what might come next year. And then, like I said, I think it was a story of thirds. So if we had that Martian come down and ask us what happened, to me, I think the first third was really characterized by that excitement of the impending rate cuts, right? And I saw that from a personal perspective, but I also saw it from a business perspective, right? Like running from probably January through to March/April, and considering you lose half of January, you're kind of only talking about February, March, maybe parts of April. So you're talking like 2 to 3 months. Everybody was convinced, right? And I would say that I'm never convinced until I see it happen. But even I was firmly in the camp of saying, from what we have at our fingertips right now, the information, it appears that this is the way that it's going to go. And I'm pretty sure I did a podcast. I think our end of year wrap up last year, I even said, it looks, again, from the information we have, it looks good. And then I think we get into the second third, which was around that April through to April, May, June, July, August maybe, so sort of May through to August, which was we had some of that economic data come out. Inflation was a bit stickier. Jobs market was performing pretty well. Mortgage arrears wasn't really doing anything. Property markets was still performing really well. And, common sense says it's no wonder the RBA didn't do anything. But I think that took so much wind out of the market, like from that sort of May through to, I reckon, August, I noticed that there was a big shift, like the enthusiasm that was present at the start of the year. Like, I can even just look at our business metrics, right? Like, we still continued to grow, but the rate of growth changed.
Is it just
massively.
malaise, really, in the whole, everyone's sort of sentiment? Everyone was like, oh, what we thought was going to happen is not going to happen. Things are hard. Inflation's kicking around. It was when we're going, still in that cycle of going, when are we going to get to the target range? When are we going to get to target range? When are we going to get target range? And everyone was quite fatigued.
And I think you can see that in the Westpac Melbourne Institute Sentiment Index. It did take a bit of a dip in that sort of first bit of the financial year kind of period. But I think more than that, like if property markets could just be brought back to ones and zeros, somebody would have cracked the equation on how to pick growth and do all that. But sentiment and psychology does come into it, and anyone who doesn't think that is probably somebody who's not a successful investor. You have to look at the bigger picture as well. We ran into winter, we then ran into, some state-based elections. We then ran into, cost of living started to really bite people because it had been running now for over 12 months of sort of, higher rates. Like I just saw, I think it's something I was going to mention later on with all my stats and data, but, I saw that now, so it's not quite in the second third, but even now we're down to household savings rate of about 0.6%. So you may as well call it nothing, like you might accidentally drop $2 down the side of your car and that's your savings for the month, So I think that second third of the year, that real middle portion, it was the wind was knocked out of everybody and everyone's going like, it's almost like when the boss says you're going to have an early knockoff and everyone's really excited. And then when that early knockoff comes and the boss goes, guys, I'm sorry, there's still work to be done. You're actually going to have to stick around till 5 p.m. And that 4 o'clock to 5 o'clock type part of the afternoon, that was the middle of the year, I think.
It was humdrum.
It really was.
Humdrum. So did things change in the back third? I guess we're in the back third now, aren't we? December.
I think absolutely. I think once we really sort of came into around that September, October period, I think that was where, especially in the media, and I mean, I'm on the record in so many different places talking about how much I hate the mainstream media for the way they talk about property, and we can probably extend that out to the economy as well. Like, we saw what happened with the government. The government almost went to war with the RBA.
Yeah.
The Chalmers, the treasurer, he came out, I don't know what month it was. I think it was probably around October. And he came out, and then that was when the water words started going between the RBA governor, what's her name, Michelle Bullock, and then Jim Chalmers, the treasurer, where he's saying the RBA is holding back the economy, and then the RBA is saying, well, no, government, here is all the evidence, not just talking trash. Here's all the evidence of government spending, which is propping up the economy and actually causing inflation. And then I think it obviously simmered out a little bit. But
I think they had a bit of a peace accord on it. But, the idea of the Reserve Bank of Australia saying what the government is doing is inflationary, and the government coming out saying, here's our budget and here's our spending priorities, and putting stimulus into the market through, power bill rebates, saying it's not going to be inflationary. You know, it's the left hand ain't talking to the right hand. And the point is that the RBA is supposed to be an independent body, not beholden to the government of the day. It should be making its decisions based on the economic sort of muscle and nuance and smarts of the people who are within it. But you can't have, what is it about a house divided, right?
It's man, absolutely. But you know what? I would have to say I give a lot of credit to the RBA governor and the RBA, because I think that when the governorship changed from Philip Lowe to Michelle Bullock, I think that, not that I have any comments about Philip Lowe. Like, I think he did a very good job. I think he was a very good governor. I think he has the unfortunate, situation of being the RBA governor during such a chaotic time that nobody had any idea of how it was going to pan out. And obviously there's now sound bites and lots of them, and I don't know if writing bites is the right term, but, things that were written down that haven't come to fruition and impacted people. But I got to give a lot of credit to the RBA governor that they have stood their ground. She has stood up to the government. Doesn't matter what government it was, Liberal or Labor, stood the ground. And I think that it has been in the best interest of everybody that they've done what they've done,
Yeah. I think they've certainly reinforced its independence. And to the point around Governor Lowe, I think, unfortunately, he's going to be remembered as a governor that told everyone that there wouldn't be any interest rate cuts until next 2025, I think his soundbite was. And that's what's been picked up. I think the current governor will not make, and I think governors in the future will not make that same mistake. I think he probably told people what they wanted to hear and probably what they thought at that period of time, but the economic realities of how, the hangover of COVID wasn't going to facilitate that. So she's just holding, she's stumped. She doesn't give anything away now. And they will make, even today, I saw some stuff around jobs data coming down, and, the RBA thinking that won't warrant cuts in interest rates. It's a tough environment, but I sort of subscribe into your idea of it being a year of thirds. So you're saying then, as we move into 2025, we're probably on a more positive trajectory. But just around out 2024, property markets, have they sort of behaved how you thought they would behave?
I think they have. I was actually looking over, when I was making the notes for this episode, I was looking at my notes from last year's Christmas episode. And I was looking at what I sort of said I thought were going to be the big impactors or what was going to go on. And everything that I said actually pretty much came to fruition. So if you want to, if you're really bored driving, and you want to listen to a 12-month-old podcast, you can go and have a listen to it. But what I said was that the cash rate was going to be one of the biggest stories of 2024, and it has. And I talked about the fact that by not, like, whenever the change happens, that was going to be a big driver, and the associated sentiment with it. And we've seen that, right? We saw it first half thinking, first third thinking, second third nothing happened, and it was dampened, and then third we're back to sort of where we are now, where everyone's sort of going for it. So I said that. I talked about how supply was, again, the biggest impactor for what was happening, and we were seeing, very, very poor numbers in construction and approvals and dwellings and things of that nature. And again, this year, it's completely gone by that, and supply has been the biggest issue. And then I also said that that ultimately 2024 was going to be a really strong property market, and if you knew where to look, you could have been making well over probably 20% gains in a year, and a lot of markets have done that.
And they have done it. And what would you say were the highest performing markets?
What would I say were the highest performing markets? I mean, I think Perth has really been a massive performer, and I think that realistically, a lot of Queensland regionals was that they were really strong performers as well, really strong performers, and I think that everyone's now thinking about what's coming next.
Yeah, and if you want to go tune into that podcast that myself and Lachlan recorded, it was you go back to 18th of December 2023, so we're pretty good with that timing.
Pretty good.
18th December 2023, and it was called Go Into 2024 Armed with a Game Plan. Who would have thought?
Well, interestingly, you talk about timings. So I think that came out on the 18th. I think we recorded it on the 12th, and then we're recording this one around that same time as well.
Here
so
we
it's
are.
it's always within.
At
a
least
couple
one
of
thing,
days.
we're consistent, just like the Australian property market.
Yes, absolutely.
So nothing really caught you by surprise for 2024 in property markets. Was there anything? I would say maybe. Like, if you can go back in time to when we recorded that to where we are today, I think we as in a collective cohort of property investors, wouldn't have thought that Melbourne would be now the fourth sort of most expensive market in Australia. So fifth, right? So Queensland, Brisbane, Perth, and Adelaide, have they got higher median prices than Sydney? Yeah, so it's 15.
Probably is. I would have to fact check that one, especially probably Adelaide.
I think Adelaide. I might be right.
Yeah.
It could be. I know it's Perth and Brizzy, and Sydney has a higher median than maybe Adelaide. I can't remember that exactly.
But fourth or fifth, it doesn't really.
Fourth or fifth. Like, you sit there and just go, probably wouldn't have sort of picked that. And I think back to the point, and no one really appreciated just how much damage was done over the COVID period to Melbourne, sort of, Victoria, as a result of some of the government decision making. You even see stories coming out now saying where restaurants are banning the former premier from attending, going he's just not welcome there because of whether or not there's any real merit to it. He's an easy target,
and that's it.
But that's it's It's that market is like, I wouldn't have picked that.
No, me neither. And I do want to talk about that later in the episode, because I do have some thoughts that I want to give on it. But it's funny, I mean, this podcast, any podcast really, unless you're doing a political podcast, is really not a place to get political. But I think that, regardless of whether I'm a Liberal Labor supporter, regardless of whether you are, regardless of any listener that's a Liberal Labor supporter, I think agnostic of that, I think it's important, like what we were talking about before in terms of influencers and putting yourself out there, and some of the things that people say and read and everything, is that I disagree with probably a vast majority of things that Dan Andrews did down there. But let's not forget, I can almost say without a shadow of a doubt, I think he did everything he did believing it was the right thing to do at the time. maybe get the bans. I saw that article. I read it and I thought it's a bit over the top.
Yeah. There's still a lot of people down there who think he's an absolute genius, and you look at there's still a Labor government. There's still a Labor government in. I think that will change, and
if they can find a way to keep hold of that at their next election, somebody needs to, political power brokers need to study exactly how that has been done.
How they're going to be. And I think there's not to get sort of too political, but I think you'll see change in state-based politics move forward, and you only need to look at. And I spent some time over the weekend with some folks from the Real Estate Institute in New South Wales. Like there is now a huge amount of fatigue at the association level, at the business level, and also the investor level when it comes to property around the taxation of Australian property at all levels. Right, like it really fuels the coffers of the state-based governments. The transactions of property stamp duty and then also land tax. It's the property industry as a collective is pretty much done with it. That they're the constant cash cow for propping up maybe ill-informed decisions taking place at a state government level. And if you think federally, the federal government's trying to kick them into gear, like just going, guys, shift development through faster. They're in many ways the state governments, irrespective of where. Some of them are performing better than others, but they are a handbrake on economic development and supporting a lot of the issues we have around housing, the ramifications of cost of living with it, and rental pricing and all that sort of stuff. So state governments, get your act in order. That'll be a trend for 2025. But what's going on with supply at the moment, sort of as we round out 2024? It's still pretty tight, right?
Oh, mate, it's still so tight. It's it's eased up a little bit, but one of the biggest problems is that I was having a look at some quick data last night when I was prepping for some of the stuff here. We've got access to a lot more data, but I just wanted to have a really quick look just to keep a more general conversation today. A lot of data providers will end up talking about data relative to a previous time period, right? And it could be like 12 months ago. Often it's 5 years ago. We can go back 10 years ago, things like that. And it's really interesting because now 5 years ago, we're almost coming into COVID time.
It's crazy, isn't it?
So everything that happened in that time that was not the norm is now starting to get assessed as 5 years ago it was this. And it's really hard. So when we look 5 years ago now, we're probably between about 10 and 15% down on overall supply in the market of things like new listings and things like that. But it's I don't think it's necessarily a fair reflection because I think there's been a lot of people who have gone to sell some property that weren't selling before, which is good. It helps to ease that a little bit. But for me, like one of the biggest ones, craziest ones, is dwelling approvals and actual construction. So it's all good and well to go and get something approved, right? It's all good and well to have that done. And I'm being careful. I don't want to say something that I want to talk about a little bit later on, but just because it's been approved doesn't mean it's getting constructed. And something like the lazy man's data is talking about dwelling approvals, right? But somebody who's actually looking at it more intelligently and more in a more sophisticated manner goes to look at how that actually matches up, because you can go at getting something approved is as simple as submitting paperwork, right? Dwelling approvals, they're actually up a little bit compared to, say, 6 months ago or 12 months ago. But interestingly, actual construction is at its lowest level since about 2011. And my 2 cents on it is that, I think a lot of people are prepping for the next 12 to 24 months when costs are ideally going to start to come down, because the biggest reason things aren't getting constructed right now, whether it's a single house and land package home or whether it's high-rise apartment blocks or stacks of units or whatever, is because you can't make the development stack up on paper. But I think that there's a lot of very smart people out there right now who are going and they are getting their approvals done. And I want to make it clear, these are sophisticated investors, right? I would say a lot of the people who listen to this podcast might have 2 or 3 properties, and that's great. You're already sitting there, really, really nicely. You're probably in the top, 10 to 20% of property investors. But don't think that just because you got 2 or 3 properties, you've now suddenly, got the runs on the board to go and do a big development or something.
Yeah, great.
Right? So I think that the people who are quite sophisticated, and I'm talking about the people like the Harry Triggerboss, right?
Yep.
I'm talking about the people that are going and doing, a 40-unit development. People who have got money and skill behind them.
Yeah.
They're stacking up on their approvals on sites.
Yeah, they're out buying sites now, and you see it coming through because the winds of change around beating down the NIMBYs and getting infield sites redeveloped around train lines and metros and all this sort of stuff. Like there is a lot of smart people now buying property who they might not realise it for a couple of decades, but a lot of people will make a lot of dough in real estate because of this. But it's a different game that most people can't and won't play.
No, and don't be a victim of your own confirmation bias either, and think that, oh man, I got this like 900 square meter block or a 1400 square meter block, and technically I could go and smack a 6-unit development on there or something. Like, put it this way: the smartest people aren't even developing right now, or hardly developing, let alone the unsophisticated people. So I think take it as a sign of the fact that nothing is happening. We are at critical supply shortages all around the country. Nothing is happening right now. We're at our lowest levels of construction in like, 13, 14 years. Yeah. And like, we still have a massive supply issue. So what am I saying? What I'm saying is that, shortly we'll talk about what I think about the 2025 market. Yeah. But I guess what I'm saying is the supply concerns, even if listings go up, is not actually getting solved for years to come. Yeah. Years to come.
And you hear the numbers bandied around about how the government's going to build so many new houses in the next 5 years and stuff. They're already behind the 8 ball. So they've got to play catch up and change all of those things you spoke about. We'll talk about 2025 in a moment in order to enact that and move it faster. Like, materials, that's expensive. People are expensive, and that's one of the biggest issues we have right now. Like, there's got to be complete changes to the immigration system so we can attract the right skilled labour in to build stuff. At prices that work. And, a lot of this is union dominated. You can't get anything done because the unions control a lot of it. Like, the unions do some good work, right? Like, they're there to represent the workers and ensure that all that happens. But in many ways also they can really stifle growth. So there's a lot of different aspects of this. And I think that's probably the back third of this year with, I think there's sort of pepped up frustration. People can probably see the wood through the trees potentially, but trying to get there is tough. Well, let's talk about 2020 is tough. Welcome back, Phil Tarrant, host of the Smart Money Investment Show with Lachlan. Is that what your mum calls you? Lockdown Vidler. There you go. There's your new name. It would have been better 5 years ago. Lockdown Vidler.
All right. How many times have you said my name over the years? I reckon that's the first time you butchered it.
Lockdown Vidler from Atlas Property. So 2025.
Yeah.
Well, 2024 for Atlas has been pretty big. You always are sort of you like to back your business with numbers around how you've been able to deliver a certain sort of amount of capital growth for your clients. No doubt that's sort of connected with some of the successes you have. I know you're a finalist for the REB Awards for 2025, which is held in February, I believe. This is the big national real estate awards for everything in real estate. Finalist for Buyer's Agent of the Year, so that's the individual award. Yeah. Innovator of the Year as an individual and Innovator of the Year as a company. So you're sort of more interested in those innovation awards, are you, than the sort of buyer's agency stuff? What sort of innovation have you done?
So, and I have talked about it before, but this year, I invested a lot of money, or me/Atlas, however you want to think about it, we've built out this massive tech platform that underpins Atlas. And this isn't something white labeled that we've just taken from somebody else. I'm here trying to spin a yarn about how it's now our software and we've done this. This was literally built from the first line of code up, right? And it's been really great because I think it's helped the performance of our clients, but it's giving them an insane experience. It's allowing them to get insights into their portfolio or into markets that they never would have been able to have before. So we spent a lot of money on that, like well over 6 figures, and it's been fantastic. So like one of the things that we did was that we built out our suburb research platform. So we have it's over 450 million individual data points in our platform across every state. Every SA3, every greater capital city area, every SA4, basically across everything for the last 20 years, right? And then across, like tens and tens and tens of different metrics. So we use that to research and analyze markets that we invest in. And then that platform allows us to do that in a way that is tenfold better than Microsoft Excel. We're able to spit out actionable insights. And then that obviously translates to our clients. So we're able to be at the forefront of any market that's performing, or when we're in a market, know when the right time to get out is, right? So we did that. We've built out our own portfolio planning software, which has been insane. So it's all housed within our platform. So we're able to plan out people's portfolios at a level we've never been able to do before, giving them those insights, being able to show them how they're going to be able to get to their 100 or 150K or whatever passive income in 20 years' time or whatever it is. So we built all that out. We've built out reporting functions. So when they see the area reports we build for clients, they can see all that in there. We're building out performance metrics for our internal teams. Then there's other suites of software that our internal team uses. And so that's what we've been nominated. That's why we've been nominated for Innovator of the Year for me personally, plus the business. Yeah,
that's cool. And so you use that for decision making on where you invest.
Absolutely. Put it this way: do you know anybody else that's got access to over 450 million data points across the country, be able to look at the past, be able to use that to try and help us inform the future, and be able to do it at such a granular level? And
so you've actually built a magic box.
We've built a magic,
Is it really magic? So what do you put some inputs in and it tells you?
Yeah,
there you go.
So we can. I guess the really cool part is because we own it. If we want to change something, we just change it. It's not like when you go and use another platform that somebody else owns. Like you jump on like a CoreLogic or something, and it's like, well, you're
just a user.
Yeah. If we don't like something, we change it. If we want something added to it, we add it.
So it's iterative. You can just continue to grow and evolve. That's cool.
Yeah.
And I know they're big commitments both in time and energy and effort and also dough. So you make sure you get that advantage. So what's it telling you about 2025? It'll probably help you with location decisioning, but there's a lot of things that we just don't know about. What's going to happen in 2025. Which you summarised. You got the election coming up. You got this catch rate discussion. You got this affordability discussion, and also sentiment. But your point around sentiment is that your indicators are that it's on the rise. Is that correct?
Yeah. I mean, look, I can anecdotally I can see that from the clients or the people that aren't clients. The prospects of people that are looking at working with us. From those conversations, from the people who do work with us, from those conversations, and then you can also see it in more sort of macro level data that comes out from surveys or other stuff like that. Sentiment is definitely positive, and I think it's because people are now beyond confident that the next move is down. Right? And I mean, never say never. There's always an X chance that it doesn't. But I think everybody is pretty certain that it's not going anywhere, right? Yeah. And everyone is seeing we've got the government still warring to an extent with the RBA. You've got every bloody journalist on the AFR and Sydney Morning Herald and everywhere else in between.
Why do you hate journos so much?
You know what? I don't hate good journos, except sometimes it's. I think it was a day probably about 2 years ago that really wound me up about it. I had a call from a very well-known mainstream journalist, and they said, "I've written an article based on this. Can you please give me comments that support the article?" And I literally said, "No, because your article is fundamentally wrong." And they're like, "No worries, thank you." And then I've never spoken to that journalist again. And it was just the fact that, it
was like fait accompli. Let me just pad out my ideas with a quote from someone who's reputable.
Yeah.
Yeah.
And
what was the story? Do you remember?
I think it was in 20. It was about 2 years ago. So I think it was towards the end of 22, and it was about the fact like the house market was going to crash in 23 or something like that. Probably not as dramatic as that, but it was effectively like it's such a bad time to buy, but if you're going to do it over here, and they were trying to use me on, I guess the opposite comments.
The counter.
They're going, "Oh no, but you could do it here." And I was like, "Guys, I'm not going to be part of this. This is just."
Yeah.
This is just
I know a lot of people in property who just refuse to take calls from journos anymore because they, rightfully or wrongfully, they think no matter what's going to happen, it's going to be a hatchet job. No matter what they say, someone's going to take a negative view on it. And it sort of happens a little bit. But it comes back to how contested the the environment is, right? Because like no one really sort of knows. Like you can offer commentary and whatnot around it, but property journos don't often have the best reputations.
I think the problem is that I think your independent journalists, right, or your independent brands are still pretty good, right? Like I think on the balance they're pretty good because there's no real massive monetary incentivization. But you go look at some of the biggest ones, right? Like your Fairfaxes or whatever. Yeah. They're so incentivized by eyeballs that property journalists aren't. Property journalists. The key there is property and then journalists, but they're not. The journalists who happen to be writing about property, and most of them have no idea.
Well, my view is that most journos I know hate property investors.
Yeah, probably.
Because they sit there and look at, and I'm generalising, and it's a friendly audience. Or most journos in general, they don't like property and property investors because they think these are the people who are keeping me out of the property market.
Yeah.
That's and a lot of journos are a bit more left leaning than right leaning, right? And they have a lot of misconceptions around what it's all about, and you see it happening inside of their coverage as well, right? They love having a pot shot at sort of successful buyers agents, and you get that. One of the reasons why we like to do this show is give you guys a fair crack, and I quite enjoy debating, if you want to call it that, with people in and around property, but. You sort of got to know a little bit about what you're talking about. So back to the point, if you just get your information around social media, you're going to get one lens of it. If you just get, all of your property information through one news channel, you're going to get a particular view of it. You've got to be discerning. You've got to be curious. And you've got to be able to actually understand what information you need in order to make your decision making. And back to those 4 points, the last one we'll chat now is around sentiment. Everyone's saying, well, as soon as that first cash rate happens, sentiment will increase and then you'll see a run. But you look at property markets now, and I think Melbourne last weekend was the best performing auction market. Auction markets elsewhere in the nation was I think Sydney was 57% by memory. I can't remember exactly the number. Yeah. It's not a market in rude health right now. There's a lot of people looking to sell properties, a lot less buyers out there, and I think that's going to be certainly carried into the first part of 2025. And a lot of this is going to be what happens with the cash rate, what happens with the federal election, because that will influence a lot of things, including affordability.
Definitely, and I think one of the biggest things right now is sentiment is impacting people because certain people aren't making decisions because they're waiting to actually see something occur before they make the decision. Yeah. And I guess I said that in a really aloof way. What I mean is people are waiting to see the cash rate drop before they do anything because they think that they need to see the cash rate drop to have the confidence to do it. Yeah. But that's why most people never own more than 2 properties, because then those same people are the people who don't really ever take a risk. And, obviously any property investing is risky, it has an element of risk to it. But like in 2 years' time, where do we think things are going to be? Like the reality is there's no way the cash rate with the current state the economy is in, given the fact that if government wasn't putting out the stimulus that they are, would probably be in a recession. And I've seen that from a number of different sources that pretty much argue that without the artificial, assistance of the government, that we'd be very close to a genuine economic recession. Yeah,
the same. So the technical recession that's been buoyed by sort of international, migrants and government stimulus into all that. You look at all the jobs growth data increase, and most of it is
social services and
government jobs. Yeah, right. And this is what you have when you have a Labor government, right?
Yeah,
they like big government, and hence the reason why where we are, and that's driving a lot of stimulus. A lot of economic sort of drivers, which are keeping inflation high and all that sort of stuff, right? But like, we're not going to solve any of this. Like, maybe a federal election may do something, though.
Yeah, possibly. And I think that's probably where I'm going with it, is that like people who are smart know where things are going to be in a year or two's time. Yeah. Because if you're a property investor and you're thinking about the next 3 or 6 months, you've already lost the game, right? Because property is a 10-year evolution, let alone a 1 or 2 year one, let alone a 3 or 6 month one. So I think like sentiment is such a driver, but the most successful investors I've ever seen, and like we have some clients who have 15 to 20 properties and yet they still work with us. Yeah. And it's because they know that the recipe for success is asset acquisition and time. And for them, they're not so worried about the things that they can't control, which is arguably almost everything in the system that actually
Most things can't control.
Exactly right. So I think sentiment's a really interesting one, but I think affordability is sort of also a bit of a key factor. Like, I spoke on our last episode, and I can't remember the date on it, but it was probably only about 2 months ago. About how affordable markets are shrinking. Markets that have that pricing of sort of sub 600, 650, and how back in 2020, before COVID really kicked off, there was over 50% of the markets in Australia would have been classed as affordable, and now we're down to about 27%. Now,
what's the definition of that? It's debt to income ratios, is it?
It was a sub 650 market. It was either a sub of 600, 650. I didn't want to get too complicated into it, but just and the way I picked that was through median incomes, median borrowing powers, things like that. That around that 600, 650 is a very typical sort of affordable price point for people to be able to buy into.
A lot of those places just don't exist anymore. Prices have gone up.
And that's my point, right? And
affordability has gone down because wages haven't. No, but they reckon it's been one of the biggest periods of wage growth this last year or so.
Nominal, not real.
Nominal, but but comparative to the increase in residential real estate, it's a very different proposition. So there is less inverted commas affordable, or we need to redefine what affordable is.
I agree,
and that's going to be very difficult because affordable is what most people, you would assume, inside that bell curve should be able to gain as a sort of access point. And there's affordability for property investors is very different than affordability for first-time buyers.
Absolutely. And I think that a really key thing that a lot of property investors either don't think about enough, or if they do, they just kind of put it to the side, is that as the affordable markets continue to shrink and then their price point becomes 700, 750, 800, whatever, rents aren't tracking with that. So the cash flow gets worse and worse the more expensive you get. And then we will be in a scenario where, it's like when you go and watch some of the, American real estate shows and they're selling an apartment in New York for bloody $2 million or whatever, and the rental yield on it is really not that great. Like the whole period of time of asset acquisition for people who are really serious about building a portfolio.
Yeah.
I'm not doomsdaying saying it's coming to an end, because you'll always be able to do it. But like the ability to do it as a typical wage earner is getting harder and harder to do.
Welcome back, Phil Tarrant, chatting with Lachlan Vidler from Atlas Property. Now, before the break, we were chatting about what does all this mean around what you can control and what you can't control. I subscribe to your point around it's going to get harder for your, inverted commas, average salary earner probably to be to build large real estate portfolios in time, and purely that's just the machinations of that is the growing disparity between affordability and standardised or average wage earning. Then it would also say that the changing nature of real estate inside of the capital city markets. It will. Properties in our capitals, Sydney, for example, maybe let's say Melbourne at the moment, but that'll spin back around. You're just going to have really compressing yields moving forward on residential real estate. There's not going to be enough to actually trigger rents to go up to keep lockstep with the comparative value of property Australia, or people's ability to rent those properties because of their salaries, right? So this is why you're seeing now a lot of property investors, I think, and trend for me for 2025, pivoting earlier to commercial real estate, to chase those yields, because that will be a driver of cash flow, and that cash flow will be a driver of the propagation of a bigger portfolio, which will allow people to maybe come back into resi. So you're going to get this sort of, normally it was resi, then commercial, never go back into resi. I think you're going to be resi, commercial, and then commercial will be the fuel for a lot more resi assets for lower yields but high capital growth.
And I think there's probably an element of that's true. But I guess, again, it comes to the hard point that a lot of people, like we're at 0.6% savings rates right now. How are people going to stump up the minimum roughly $300,000 that you need today to buy any commercial asset at a lower level that's worthwhile buying?
Yeah.
Like, imagine having 300, like most resi investors that we see, like honestly, the amount of people that we speak to on a daily basis that talk to us, they only have like 60 or 70K. And like for them, they have worked so hard to get there. And it's certainly not a denigration on their hard work, because they're dealing with so many difficulties around affordability right now. But 60, 70 grand can't really get you anything anymore.
No.
So how are you going to get to 300 or 250? You know, it's we're getting to that point. The wealth get wealthier.
Tactically, you've got to do a lot more. Like you've got to sell your big family home and move into something smaller and allocate the money, like changing, shifting habits and how you choose to live. But it is getting harder. But there's nothing wrong about that. That's just the way it is. It's just the way it is. So therefore, it's the incumbencies on the investor to be a lot more smarter and strategic and tactical in how they go about building out with it. And that's going to be the trend you're going to see certainly into 2025. But asset selection is going to be critical.
Absolutely.
Market selection is going to be critical. I don't know what you're seeing. How's Perth, Brizzy, Adelaide? We sort of spoke about them briefly, or even regional markets. How do you see them performing?
Look, to be honest, I think they're going to keep performing, right? I'm never going to sit here. I don't think anyone will ever get me on a podcast and put a number out there because I think it's just impossible to actually know where it sits. But to me, look, I think they're going to keep performing, right? Whether that means that we call that 8 or 9 or 10%, or whether we're calling that 15 to 20%, it's not really too important to me because both those sets of numbers, by any metric, is performance. If you had a property that went up by 8 or 9% in a year, by long-term standing standards, that is a good year of property performance, right? That's a solid year. It's like a lot of people, and it's something again we see a lot. A lot of people have misset expectations of what property should do in a year. They think it should be going up by 20% or 30% and 15%. Yeah, it's all right. Like, don't worry about it, right? That is not the norm. And you get a professional on your side. Like, I can appreciate you might want a little bit of better performance, right? Especially if you're going to pay some money. But even notwithstanding that, like the long-term running average is, and there's differing numbers on it. I've got sources for all of it, but it's anywhere from about 5.5% all the way up to about 7%, 7.25%, depending on what source you get, how they got their
compounding annual growth.
Compounding annual, and that's
average
over
annual growth,
like lifetime, 30, 40 years worth of data, right? That is nowhere near a 15% or 20% number, So I think that unfortunately a lot of people have gotten some complacency around that to think that's the standard.
That's normal. Well, that's why you get back to our earlier point around social media. That's why you get sold on social media. You know, like how I was on minimum salary and which I think 20 years ago you could do this because the price disparity was very. If you're on a minimum salary back then, 50, 40 grand a year, you're buying property at 200 grand a year. It's a very different proposition now, and you see these stories of like how XYZ on a minimum salary of this was able to build a portfolio of 10. You go, that's BS.
Yeah,
it's not true.
They started in the 90s or the 2000s, or at the very latest, probably sub 2011, 2012.
Yeah, it's very. If you start now on a minimum salary, it's very, very hard to do it. And if someone has done that, they're not telling the truth, the whole truth.
Definitely.
There wouldn't be like, their parents gave them this big deposit or they got this big guarantee or whatever. Like, if that's the case, tell the story. Like, be factual. That's one of the reasons why we started Smart Property Investors, because we saw it 15 years ago. It was like, this is all BS.
Yeah.
Like, yes, you can make money in property, but tell the full story, And
I think no, like to bring a bit of hope back to people to not think of property.
Don't invest in property. Give up.
Is that you're absolutely right. But along the same train of thought, I think you'd probably agree with me on this. All we're saying is you're not going to hit the lotto in 5 or 10 years in property, right? If you're a typical wage earner, unless something outside the norm happens to you, which can accelerate you, the reality is it's going to take you 20 years. And after 20 years or 25 years, you'll probably have 100K or 110K in today's context, today's terms, of income out of the portfolio. So if you conceptualize for that today to go, if I had 100 grand, I wasn't going to work, is that good? Most people go, shit, that's unreal. Like the age pension for a couple on full pension is a whisker over 50 grand. So you think if you're starting today and you work a really typical job, not somebody that is an insane high income earner, which they are, those social media people that look lavish but aren't the reality, right? By the time you fast forward 20 years, if you've been able to acquire 5 or 6 properties over 20 years and you didn't have any family help or anything like that, and you've literally built it yourself, you will probably have that 100K in today's dollars passive income if you do it the right way. You combine that with the fact that your entire working life would have had super paid to you as well. You're going to end up in a position where you've probably got you could probably retire at 60 or 65, which is about, I guess today it's about norm, but in 20 years, it's probably gone up again. You would probably be able to retire at 60 with 150K in today's dollars of income between your properties, your super, and probably some other personal savings, which is an insane amount of money for the average person. An insane amount.
Yeah,
but
and what
it takes 20 years.
But it takes 20 years, and what it also means maybe is, everyone's fixated on these super duper capital growth type properties, and to your point, if you use a professional, the likelihood of identifying them and getting maybe out of market norm. The immediacy performance is probably high, but that's not going to be forever. It's going to be for a moment in time, and therefore you might need to look at markets where it is, inverted commas, a little bit more affordable, regional. So a lot of people tell you don't invest in regional areas because blah blah blah. You should invest in blue chip properties. Like, it's horses for courses.
It is.
It's horses for, it's what you can, and you might start off investing regionally, and you might do well there, and you might be able to prepare yourself to propagate a different portfolio and investing in capitals. That's all okay. But you compete. It's a very competitive market. I'd say there's a lot more property investors around these days. And
100%.
The information for property investors today is a lot more than what it was when I started investing like a decade or so ago. But there are opportunities out there. We spoke really quickly about Victoria. You don't need to be a genius to work out something's not adding up in the Victorian property markets at the moment. And they may be like that for some time, but you've got to look at that and just go, something's going on here, because then I look at Perth and you say, look, those markets will perform. There's going to be a point in time when you've either missed Perth or if you go into Perth, you really should be investing somewhere else. And I would say it's now.
Yeah.
Other buyer's agents, the buyer's agent will tell me, no, there's still legs to run. But, are you better off deploying your money into the Victorian market, for example, than something like Perth, which has showed steady, out of cycle market growth and maybe steady market growth now? What's going on in Victoria?
Well, I think to bring those 2 points together, I think it's also about understanding the nuance, right? Because Victoria is an entire state, Perth is a whole city, Brisbane is a whole city, right? I think at a more micro level, there are always going to be places that make sense to still be investing in anywhere, right? Anywhere at all, right? But I think that it's also important to just be fact driven. Use your analysis, like whether it's your analysis, whether it's professionals' analysis, use that to support your position of where you're at, right? And then it helps you to understand, because I think you go look at somewhere like Victoria, right? Like, it is a no-brainer that there is going to be growth to be had in Victoria, right? It's a no-brainer. It will happen. But I think it also depends, what's your aim? What's your outcome? Because I see a situation, and we've only started, as a team at Atlas Property Group, looking into the Victorian market, and we're not buying there. I'll be very open and say we're not buying there right now. We're just starting to get on top of the data to understand it. Is that, for me, the causes of why Victoria has dropped the way it has have not been solved, and the causes start and end with the government and their decisions, right? And all those things are still in place. I'm pretty sure the election is not till 26 in Melbourne or Victoria.
Yeah.
So I see a scenario potentially, because who knows? Maybe we'll start buying there next year. I don't know. We'll see, because it's always about understanding the situation, the data, and all that. But I do see a scenario where Victoria starts to be somewhat artificially propped up by property investors who are trying to go in there and seek it out when the data may not necessarily support that. And then I think coming back to title together is that for somebody who maybe can't buy a property for the next somebody who can buy a property now, but they probably aren't going to be able to buy another property for, say, 3 or 4 or 5 years, maybe it makes sense to get into Victoria now, because there's not really an opportunity cost, because even if you had strong performance in another market, you're not going to be able to recycle that equity out to go somewhere else. So maybe it makes sense to go park it down there, get it from the absolute bottom of the cycle, kick it up, and then in 3 or 4 or 5 years, I've got every confidence that the market will have normalized down there, and you're going to have experienced it, and you'll be thinking, hoorah, right? But equally so, if you're another investor and you could be moving into multiple properties in a short time, you might want another market that has really good short-term indicators, not obviously detrimental medium to long-term ones, because you don't want to just lose the value, but it might make sense for you to go to a market like a Brisbane or a Perth or an Adelaide or a regional that's been performing or whatever it might be. It might make sense to do that because if you get 6 to 9 months of strong equity growth and you can pull that out and then you can go buy another one and then you do your Victorian one that's like a more long-term play, or another one that you want that quick uplift, make your quick money.
So you got to trade,
Exactly right. So I think that's where it really comes down to making sure you understand how to build a portfolio and what that portfolio looks like and what you're trying to do and the aims and the outcomes of it. Because somebody who has massive capacity that goes to Victoria right now, I would be really worried about their ability to manufacture quick growth to leapfrog on into the next property, because you might be somebody that's got, let's say you got 1.5 mil of borrowing, but you've only got 150K of cash, right? You could buy maybe split that across 2 properties, but more likely, or if you drop it down and say you got 120K, you could buy 1 property with some change left over. So your only hope of being able to quickly expand your portfolio is to see an equity uplift in a market and then recycle that. So if you go somewhere that is damp, even if you get the full swing, but that dampness takes 2 or 3 or 4 years, like think Brisbane 2011 through to 2020, you got capital that's stuck.
Yeah, and I had that.
You know?
I if you want to use a sort of an analog to Victoria, I entered the Queensland market earlier than most, and nothing happened for quite some time. But now it's been a good investment, right? Could have I deployed that capital somewhere else over that period of time potentially, but I'm okay with the outcome, right? To your point around, do you go somewhere that's going to be artificially propped up by investors or buyers agents? There's an argument to say that's Perth, right? Like,
and possibly, right? It could be lots of places.
Lots of places. So you just don't know. You just want the biggest bang for your buck. And that's the decision making you need. So as you sort of consider all this, then what's going on with the cash rate and what market's going to perform and what's going to happen in the election and is going to get GDP growth and all this sort of stuff. What do you do about it?
Well, I think
what would be your sort of couple of steps just to conclude this podcast?
Yeah. Well, I think the key part here is what we were talking about before about you've got the people that are gunners and you got the people that are doers, right? And the gunners are the people that sit back that are always, I'm going to do this, I'm going to do that. And they're the people that are saying, I'm going to invest when rates drop. I'm going to invest when this happens. I'm going to invest when that happens. And they're the people that either never do it or they're the people that aren't really that successful because they're not really thinking strategically about it. So to me, the very first thing is you need to understand your portfolio planning scenario, right? And we're talking before about like one of the new pieces of software that we built from scratch, which is the portfolio planning software. So if you don't have a portfolio plan, you need to create one, or you need to come and talk to us and we'll help you create one. Or if you have one, you then need to think about where you're at in that, because if you know where you're at, or you get someone to help you to find out where you're at, you can then understand what your direction is. And then from that, you then need to start to, get on the road, hit the frog and toad, right? You got to get moving to actually make decisions. And that starts with getting your admin done, like get your finance approved. If you're using structures, get your structures set up, whatever it might be, get your accounting advice, blah, 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 blah. But then you got to actually start to make your moves.
Yeah.
Because otherwise you're a gunner and you're not a doer. So if you're a gunner, then that's okay, right? It happens, right? And that's why most people. That's why
most of the gunners.
Yeah, most of the gunners. The stats tell us that the numbers are out there. Whether it's property investing or other types of wealth or other types of success, most people are gunners and they aren't doers, right? Yeah. But if you are a doer, that's your time to come chat with me. Come chat with me and the team at Atlas Property Group, because
you can't help yourself.
Plug right at the end. But you know what? I think at the end of the day, people listen to the podcast. They've heard me for years and years and years. They know we're doers. We're not gunners. We're doers. Yeah. And we've got the proof in the pudding. So if you're a doer, you want to go work with doers.
Yeah. I agree. Sometimes you actually need that. If you have all the right intent, you just need a catalyst for change. Sometimes that's speaking to someone like yourself who can help you with that. So probably too late for 2024 now, because you're probably not going to be available. You guys, a lot of people use the break also to think about these type of things. We see podcast plays over this period are typically pretty pretty high, right? Because people are trying to work this stuff out, and they go, I'm gonna do something. New Year's resolution. It's going to be the year, right? So you guys, when does the open sign happen back on Atlas?
So we'll jump back in on the 6th of January. But this is certainly not my first Christmas of running a business and all this. Yeah. What I'd say to anyone is, if you are going to be a doer, not a gunner, as soon as you listen to this podcast and you make your decision, go to our website and drop the website inquiry in, because whilst we're not going to be able to physically have a chat with you until then, you send it off. We are going to be in touch. Yeah. If I can convince my team to every few days monitor emails over the break, we'll at least try and shoot you back an email and say, hey, when are you free?
Yep.
But you got to take the first step.
You got to do it. 90% of winning is beginning.
90, and you know what? You miss every shot you don't take.
There you go.
So
it's good. Well, mate, I've enjoyed working with you over 2024, mate.
Thank you. You know,
too, it's there's lots of that's been happening, and I've really enjoyed seeing some of the other content you're creating sort of emerging out. Pathway to Property. It's on the Property Investment Podcast Network, where you're tuning into this, or where you can find it and all the other podcast platforms, and also the Property Investment Australia podcast, which you've been doing for a little while. So, no shortage of info out there, mate. Keeping you busy.
Mate, keeping us very busy. But you know what? We get a lot of emails, and even people on the phone that we're chatting to about possibly investing that say stuff. And we actually just get a lot of people that say, you know what? Thank you for doing it, because people just love the content. And I think that, I'm sure there's lots of people out there that maybe don't resonate with what I say, but I know there's also lots of people who do resonate. And I think regardless of whether you do or you don't, I know how much people love property, and I like to think that, especially when we sit down and have a chat, we always just try and talk factually, and whether you agree with my approach or your approach is not important. But I think that it's always nice to know that, whenever people are listening in, that they just appreciate the fact that people are out there trying to help them. Yeah. And it's up to them to decide whether they want,
and that's help. It. You got to be responsible for yourself. But you do a favour for me. I never get any feedback. Can you sort of leave some reviews on the Property Investment Podcast Network, where you're tuning into this? 5 stars if you think that's right, and a couple of things. It's one thing I don't. But I always find buyers agents get a lot more feedback. I get zero featback. I think people just go, this idiot. I don't know what he's talking about. But good to see you, mate.
Thank you, mate.
I'll let you go. And Atlas, what's your website?
atlaspropertygroup.com.au. Nice and simple.
Easy. atlaspropertygroup.com. There you go, and check it out there. And the point is, you got to start sometime.
Exactly right. And you know what? The hardest step is beginning, whether it's the gym, whether it's property investing, or whether it's just having a healthier meal. You got to do it the first time. Smartpropertyinvestment.com.au. There's heaps of stuff. We're publishing info right over Chrissy, so make sure you keep dialed in and keep looking out for these podcasts. There's going to be plenty over the break. I'm Phil Tarrant, Smart Property Investment on the social medias where you can find us. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.